Welcome. This is CPA question 5 of August 2021 sitting, and it is CPA section 1. So CPA section 1, financial accounting paper. It's financial accounting paper, and it is for August 2021. It's for August 2021. August 2021. Okay, so we go straight to the question. Question 5, explain 3 roles played by accounting officers in public sector accounting. That is from public sector accounting. And then we have question B. What do they want? They want, it's a question on ratios. That is analysis of financial statement. So let's dive into the question. We'll start with part A of the question. And we'll straight away do our solution here. So we have A. Explain 3 roles played by accounting officers in public sector accounting. Roles of accounting officers. Roles of accounting officers in public sector accounting. Roles of accounting officers in public sector accounting. Now, roles of accounting officers in public sector accounting. Just from the question, they want how many? This is 3 roles. In fact, they are very clear. They want 3 roles with 6 marks. So we'll try to explain some of these roles, and we'll go straight to the key roles. Number 1, the first function of accounting officers in public sector accounting is to ensure that there is that conformity and adherence to the Public Procurement and Disposal Act. Public Procurement and Disposal Act. That means that they follow up to ensure that the PPDA, Public Procurement and Disposal Act, is followed to the letter. The rules, the procedures are followed to the letter. And of course, when we follow the procedures to the letter, we will be trying to mitigate the chances or the possibilities of fraud. And by doing that, we'll be protecting the monies or assets that belong to the entity. So their key mandate is to ensure the adherence and compliance to the Public Proposal and Disposal Act, especially on issues to do with the procurement. Number 2, they also have the role of ensuring that they maintain or monitor the public expenditure and revenues. And this is very important, especially through the internal checks. So these people have the mandate to ensure that we have internal checks and controls that will help ensure that all the public monies are put into the most efficient use. And then the other role of accounting officers is to come up with prepare or develop the departmental budgets. And this is done almost on an annual basis. It is this budget that will go all the way up to the parliamentary budget, the one that is heard before the parliament. So the accounting officers have participated in the preparation or development of the departmental budgets, which will go all the way to the national budget. Number 4, they also have the role of oversight. They basically play the oversight and they play the oversight role in checking the compliance levels to the accounting and legal rules that have been set. They play the oversight role in ensuring that an entity complies with both the accounting and the legal rules that have been set. They participate also in coming up with actually analyzing and preparation and analysis. I think we'll talk of preparation and analysis of the financial reports. So most of these entities will require financial reports, and it's the accounting officers who are charged with that mandate of ensuring that they come up with the financial reports that can communicate the well-being or how the proceedings of basically an entity. Other than that, it is these accounting officers who also are expected to offer financial advice to the various users of accounting information, We can go on and on and on. There are so many roles of accounting officers in a public entity that these ones are outstanding. You can add others to ensure efficiency and effectiveness, especially in all the processes, for optimum results. This is also one of the functions of the roles of the accounting officers in a public entity. So all these are roles, and any of these should be able to give you the 2 marks that you so much need. So any 3 points will give you 6 marks, but it's not a mistake for you to go 5 points, 4 points, 6 points. If you have them, you can write. It's okay, but make sure you start with the strong points first before you embark on some of the weaker points that possibly you may be doubting. Okay, so let's go to the second part of the question, and that is part B. The following are the financial statement extracts from the books of Karamu traders. So sales on credit, cost of sales, gross profit, expenses, net profit. This is just a financial statement, which is very brief. This is what a financial statement basically encompasses. Sales, less cost of sales, you have gross profit. Add incomes and gains, less expenses, you have net profit. Then statement of financial position. This is now the equivalent of a balance sheet. We have non-current assets, totals are there, and you can see this is for 2020 and 2019. So we have 2 years here, 2020, 2019. The same thing with the balance sheet. This is 2020, this is 2019. Equity, so we have assets, non-current assets, we have them there. Current assets, we have them there. Then the assets are balancing the way they have done. It's basically assets vis-a-vis the liabilities. So you can see assets 132,000, liabilities 132,000 for 2020, assets 70,000 for 2019, liabilities 70,000 for 2019. Additional information: there were no purchases or disposals of non-current assets during the years ended at 1st December 2019 and at 1st December 2020. During the year ended at 1st December 2020, Karamu traders reduced their selling prices in order to stimulate sales. Then assume price levels were stable and assume a 365-day year. So what are we required to do? For the ended at 1st December 2019 and at 1st December 2020, compute the following. So it's just computing. Ideally, they will have possibly asked that we compute these for 2019 and 2020 and explain what is happening, if the firm is improving in performance or if it's dropping in performance. Just give at least a comment on the performance or interpretation of the ratios, what the ratios mean. But looks like from the question they are not so keen on that. They just want you to work out what they are asking, the ratio for 2019, the ratio for 2020, and from the way they are awarding the marks, each of these will give us 1 mark. So you work gross profit markup for 2019, 1 mark, gross profit markup for 2020, 1 mark. So it's not that complex question. It's a pretty straightforward question. So let's try it out, see how it goes. So question 1B, solution question 1B, and we'll start with the first part. Question 1B. So they're asking for gross profit markup. Gross profit markup. Gross profit markup. So we are going to have to look at it from this angle, 2019 and then 2020. And I think before we look at 2019 and 2020, let's just do the formula. So gross profit markup, the formula is, gross profit markup formula is gross profit over the cost of sales. Cost of sales times 100. It's normally expressed in percentage, that's why we are multiplying by 100. So it's gross profit over cost of sales times 100. So then we will come here and say 2019 and 2020 because we are using the same formula. So 2019, come here. This is 2019, don't confuse. So gross profit is 80,000. Cost of sales is 160,000. So we simply come back here and say in 2019 it is 80,000. That is a gross profit over 160,000 times 100. This will give us 50%. So our gross markup in 2019 is 50%. We go back 2020. 2020 gross profit is 100,000. You can see the figures here, 100,000, and then our cost of sales is here, 300,000. So gross profit here, we simply, in 2020 we say, oh, I've forgotten the figures. I think it was 100 and 300. Let's get 100 and 300. Yeah. So it's 100,000 divided by 100,000 divided by 300,000 times 100. This gives us 33.3%. So this is our gross profit markup. Markup is gross profit over cost of sales. Cost of sales. There's a difference between gross profit markup and gross profit margin. What is very common is the gross profit margin. Markup is gross profit over cost of sales. So let's come back here to the second part. We are done. So this is 2 marks. Gross profit margin. We are talking about margin. We didn't know it was the second question. So this is Roman 1. So Roman 2, gross profit margin. Gross profit margin. So gross profit margin. The formula is, you always start with the formula. So the formula for gross profit margin is gross profit over sales times 100. That is the formula. So we come back here and say in 2019 and in 2020. So in 2019, let's pick the gross profit. I know in 2019 it was 80,000 and in 2020 it was 100,000. The figures I just up there, we have used them before. So multiply by, you interpret the formula, multiply by 100, multiply by 100. So what you are going to pick up there is the sales. You are going up there to pick the sales. There was something about the sales. There are no purchases. Reduce the selling price in order. Okay, that one doesn't have any effect. So we come here. Sales in 2019 to 40. Sales in 2020, 400. Sales in 2019 to 40. Sales in 2020, 400. So 240 and 400. In 2019 it's 240 and in 2020 it's 400. Like that. So this will give us 25% and this will give us, I think this is 30% if I'm not wrong. No, it's not 30%. So it's 80 divided by 240. That gives us 33.3%. So this is 33.3%. 33.3%. Just like what we had up here. So 33.3%. So this will give you 1 mark and this will also give you 1 mark. So that's our second item. Then we go to the third item. The third one is net profit margin. Net profit margin. You can see these questions are not net profit margin, but you need to know. You need to have this in your fingertips. The moment you don't know the formula, you will not get this question right. Otherwise, it's just easy maths. So the first step is formula. And net profit margin. The formula is also net profit, just like the preceding example. Net profit over sales times 100. That's simple. So you just say 2019, 2020, and then we go back up here, pick the net sales. What is the net sales? Net profit. Net profit here is let's pick the same from sorry, this is not responding, but you can see from here net profit is 70,000 in 2020 and 60,000 in 60,000 in 2019. There is some bit of a problem. This thing is not responding. I hope now it's responding. Yeah, there we go. So net profit 70,000 in 2020 and in 2019 60,000. The figures are here. Net profit 70 and 60. So we simply come here and say this is 70,000 over sales, which is to 40,000 times 100, and then this is 60. Looks like we interchange them. You need to be very keen. Let's be very keen. You need to be very keen. In 2020, 70,000. In 2019, 60,000. So 2019 is 60,000 and 2020 is, so 2019 is 60,000. 60,000. 2020 is 70,000 over, now this one, the sales, which is 400,000 times 100 times 100. So we'll start with this one. 60 over 240, this is 25%. And then this one is 70 divided by 400. That gives you 17.5%. 17.5%, like that. 17.5%. So then we go to the next item. That is number 4, Roman 4. And Roman 4 now we have, what is this Roman 4? What does Roman 4 have? Return on capital employed, ROCE. Return on capital employed. Return on capital. Return on capital employed. And as usual, our first step will be the formula. And the formula is net profit over the capital employed. Net profit over capital employed times 100. Net profit over capital employed times 100. So net profit 2019, 2020. So in 2019, net profit is 60,000 over capital employed. There are two ways of getting capital employed. Capital employed, you can just go to the finance by section. That will be capital employed. Or you can also get the capital employed by adding the non-current assets plus current assets minus current liabilities. All this will give you the same answer. Finance by section. So we can just try it out and see how it goes. Let's come back. Finance by. So finance by is here. Capital and reserve. This is the less drawing. So this will be our capital employed. Capital employed. This will be our capital employed. But we have said that the other way of getting this is by taking the non-current assets. For example, this one is 30,000 plus total assets. Oh, we've already, so the total assets already 70,000 minus 12,000. You can see 70 minus 12 will have 58. So, and this 70 is non-current assets plus current assets and current liabilities. You get this. So all of them will give you the same answer. Capital employed can be equal to and current assets plus current assets minus current liabilities, or you simply go to the finance by section and pick that figure. That is capital employed. So what is capital employed? For 2019 it was 58,000. For 2020 it's 82,000. So 58 and 82,000. 58 and 82,000. This is 58,000, 58,000 and 82,000, and then you multiply by 100, multiply by 100. So 60 divided by 58, 60 divided by 58, that gives us 1.034. This is 1.034%, and the other side we have in 2020 what have we written? We have written our own stuff here. So in 2020 the net profit is 70,000. So it's 70,000 divided by the capital employed, which was 82,000, times 100, which gives us 70 divided by 82, and gives us 8.536. 8.536%. 536%. So that's how it is. Sorry, like I'm multiplying my own things. Here, this is 60 divided by 58. That is 1.034 times 100. Sorry, times 100. So this is supposed to be 103.4%. And then this side it's 70 divided by 82. We have 0.85. So that should be, this will give us 85. It is 0.85. So it should give us 85.36%. Now that is correct. I was not factoring in the 100. So that's how it is. We can delete this just for the sake of by the way. So our return on capital employed 2019 was 103.4. We did better. In 2020 we performed slightly. We underperformed compared to 2019 and dropped to 85.36. Return on capital employed, how much if the capital that has been employed by the business is giving us good returns, or basically knowing the rate of return that the capital employed is giving us back. So now let's go to item number 5. That is ROCE, so current ratio. Current ratio. Current ratio. So the current ratio is equals to current assets over current liabilities. Current ratio is equals to current assets over current liabilities. It's a ratio. So 2019, 2020. Simply go up here, pick the current assets. The current asset is current assets, total current assets. They are here. So total assets, total current assets. We're interested in total current assets. So it's this 108,000. This one 108,000, because we have added inventory plus trade receivables plus cash at bank. This is total assets. That is current and current assets plus current assets. We are not interested in this. We are interested in the current assets only. So 108,000, and then this side is 40,000. So 2019 is 40,000, 2020 108,000. Then current liabilities, here we go, 50,000. We are not interested in the total liabilities. When you add this plus this, you get total liabilities, but we are interested in current liabilities. So it's 30,000 plus 20,000, which is 50,000. This is the figure we're interested in, and this is the figure we're interested in 2019. So 2019, It will be 40,000 divided by 12,000. 2020, 108,000 divided by 50,000. So 40 divided by 12. Let's pick that one first. 40,000 divided by 12,000 in 2019. Our current asset was 40,000 divided by our current liability, which is 12,000. So how this one doesn't have multiplication. These are liquidity assets. So we simply get a ratio. A ratio is this expressed in relation to this. So we'll simply say 40,000 divided by 12,000. That gives us 3.33. So we'll talk of 3.33 to 1. That's how we express a ratio. That our current assets are 3.33 times more than our current liability. So it means this firm is doing pretty well, we can say. It's doing pretty well. And let's just see how it performed in 2021. In 2020, it's 108,000 divided by 50,000. 108,000 divided by 50,000. So 108 is the current assets divided by 50,000. This gives us 108 divided by 50 divided by 50. That gives us 2.16. So it means our assets are 2.16 times greater than our liabilities. It depends. Normally, stronger current ratio may not be good, because it means you are not utilizing other potential as good as you're supposed to. But so long as we are talking about 2 to 1, if the ratio is 2 to 1, it's good enough. So we can say this is how the farm has fared on 2019, 3.33, which was way higher, and in 2020, 2.16 to 1. So the assets are 2.16 much greater than the liability, which is still good. All of them are good. So let's look at the next item, which is VI. Number VI. That is acid test ratio. So acid test ratio. And acid test ratio, we are looking at how quickly we can meet the current liabilities in case need arises. So we are looking at the assets that are very liquid as opposed to just assets. Here we are interested in assets, the ratio of current asset, current liability. But here we are interested in how easily we can convert the current assets that can be easily converted into cash form to sort out problems that are maturing like immediately. And it's also called the quick acid test ratio, and it's almost similar to, it behaves like the litmus paper, the common litmus paper, that how we want money like immediately. So what is our ability to meet this current maturing obligation like now as an emergency? So we talk of the current assets which are very liquid compared to others. As much as all of them are current assets, the others which are more liquid than others, they can easily be converted into cash compared to others which might take some little of more time. Like a good example is inventory. Inventory, yes, they are assets, but you have to sell them. But they will have these assets that are readily available and can easily be converted into cash, like cash at bank, like the treasury bills that those are things that can easily be converted into cash and used to meet your current maturing obligations as and when they fall due. The marketable securities can easily be converted into cash. So what we normally do is acid test ratio, the formula, quick acid test ratio. The formula is simply current assets minus inventory and minus prepayments, so that we remain with those assets that can easily be converted into cash should need arise over current liabilities. Current assets minus inventory minus prepayments over current liabilities. So let's go to 2019 and 2020. What does 2019 have for us? 2019 is asset test ratio. So we simply come back here, inventory, trade receivables, cash and bank. Trade receivables are considered, this is money, your money, you can just ask and they pay. So here we'll only have 108 minus inventory because we don't have prepayments. Additional information, we don't have prepayments. So it's 108 minus 36. This is 2020. Let's start with 2019. So 2019 could be 40, which is the current assets, minus 14, the inventory. So 40 minus 14 over current liabilities, which will still remain at the same figure. So 40 minus 14 over 12,000. So we come here, we say 40,000, which is the current assets, minus 14,000 over 12,000. This will give us 40 minus 14 over 12. 40 minus 14 over 12, that is 21.67. 2.167. That is 2.167 to 1. 2.167 to 1. And then for the year 2020, we will have 2020, that's where we are, 2020. So what do we have for 2020? 2020 will be 108 minus 36 over 50. 108,000 minus 36,000. 108,000 minus 36,000. 36 is the inventory. The rest are just the same. So 108,000 minus 36,000 over 50,000. Like that. So let's get the answer. 108 minus 36 over 50. That gives us 1.44. So this is 1.44 to 1. So it means the ability of this one to meet its current maturing obligations are now it's 2.167, which is good. And in 2020 it was 1.44, which is still good because all of them are greater than 1. It means the firm has the capacity to meet their current maturing obligations. Then we have the last one. I think we're going to the last one. This is accounts receivable collection period. Accounts receivable collection period. So accounts receivable collection period. How long does it take for us to get our money from the debtors? So the first thing is the formula for this, and the formula is the average debtors. The average debtors we collect money from accounts receivable debtors. So the average debtors over credit sales. We are only dealing with sales which are made of debit over times the number of days, and in this case we talk of a year. That's, I think, one of the assumptions they have given us is that a year will have 365 days. So accounts receivable, these are debtors. So we are only asking ourselves, how long does it take for us to receive money from our debtors? And of course, the credit sales, we can only receive, debtors are from credit sales. So we take the average debt divided by the credit sales. So multiply by the number of days because we are interested in the number of days. A year has 365 days. That's why we have that 365 days. So average debtors 2019. Normally what we do for average debtors, we take the opening debtors plus closing debtors divided by 2. That's what we do. But in 2019, we only have the closing debtors because this is a balance sheet as at 31st December. 31st December. So debtors, trade receivables, these are the debtors, trade receivables. So in 2019, we have 24,000. Do we have the amount that was the debtors amount at the beginning of the year? We don't have. If we will be having, if we could be having 2018 also here, then we could have the beginning amount of debtors, but we don't have. So in this case, we'll just pick the 24,000 and use it because we don't have any other figure to average with. So it will be 24,000, our debtors, divided by the credit sales. What are the credit sales? Credit sales Yeah, credit sales all on credit. In 2019, you have 240,000. So it's 24,000 divided by 240,000. So we'll come here and say 24,000 divided by 240,000 times 365. This is a turnover, generally the turnover or activity ratio that shows us how fast, the number of days that it takes for us to collect our outstanding. So 24,000 divided by 240 equals 0.1 times 365. So this is 36.5. This is 36.5 days. So it takes us 36.5 days to collect the money owed to the money that to collect the money that the debtors owe us. 36.5 days. Whether we are doing well or we are not doing well, that depends with what we are questioning, what we are comparing with. But it takes 36.5 days. Our money is outside there with the debtors. So average 36.5 days for us to collect our money from the debtors. Let's look at 2020. What 2020 has for us. So 2020 opening plus, remember this is the formula for average debtors. So 2020, for 2020 you have the opening. So this is the closing debtors balance for 2019. So if it's the closing debtors balance for 2019, it will definitely be the opening balance for 2020. So we'll be talking about 24,000 plus closing, now this one, 72,000. That is the closing. You can see this is at 1st December 2020 divided by 2. So this will give us 96,000 divided by 2. 96,000 divided by 2. Yeah, 96,000 divided by 2, which will give us 48,000. So average will be talking about 48,000. So we'll simply come here and say 48,000. 48,000 divided by credit sales. And in 2019, the credit sales, for credit sales is not an average, so just go to 2020 credit sales 400,000 and we'll be done. So divided by 400,000, 80,000, 48,000 divided by 400,000 times 365. So this will give us the number of days it takes for us to collect our money from the debtors. So 48 divided by 400, 48 divided by 400 times 365. So it takes us 43.8 days. 43.8 days. What this means is that 2019 is even better than 2020, because 2019 we were collecting. It's the common, actually what is supposed to happen is that we are supposed to reduce the collection period as much as possible. Any business always seeks to reduce the collection period. We need this money in the business. So what this means is that 2019 we are doing better because it takes lesser number of days than in 2020. In 2020 we lapsed and we are not doing quite well in terms of collection. We are taking more time to collect as compared to 2019. So all this will be giving you 1 mark. I've been trying to interpret the information, though the examiner is not interested in the interpretations, he's only interested in the answers. And that explains the 2 marks, 2 marks each. That's how to go about it. Please just know the formula, and these formulas can be understood. You don't need to cram them. Just seek to understand the formulas and they will just come in, especially at your hour of need when you're answering this question. These are booster questions. Once you know the formulas, there's nothing else to worry you. It's just interpreting the formula and you have the answer. And make sure that you get the units well. Like you can see, this is 33%. These are profitability ratios. Most the profitability ratios are always in percentage. Profitability ratios in percentage. Liquidity ratios are always in mostly they are in ratios, and then the activity ratios are always in can be expressed in the number of days, but it depends. Just be keen on the units that you are going to use. They should be the most appropriate units. So with that, thank you. We meet in the next question. Welcome. You can share, subscribe to our channel, and you can also register, enroll with us in our online learning school. Welcome.